The financial markets, a vast ocean of opportunity and uncertainty, often feel like navigating a storm without a compass. We are told to predict, to forecast, to anticipate the unpredictable. But perhaps the greatest wisdom, as our friend Warren Buffett once noted, lies not in intellect alone, but in temperament. It's about knowing when to act, and perhaps more importantly, when to simply sit, observe, and understand. This journey, beyond the ephemeral headlines and the cacophony of daily market noise, leads us to a deeper truth. It's about discerning the subtle whispers of economic signals, the understated indicators that often foreshadow the most significant shifts. These are not crystal balls, but rather time-tested patterns, echoes from history that can illuminate our path through the present. We often find ourselves adrift, tossed by waves of fear and speculation, unsure of the underlying currents. This video is designed to be your compass. We will move past the superficial, beyond the fear-mongering, to uncover 7 critical economic signals. These are not mere predictions, but rather data-driven insights, a framework built on historical understanding, designed to transform your apprehension of market downturns into a posture of informed, strategic preparedness. This is about understanding the landscape, not to control the uncontrollable, but to navigate it with clarity and conviction. Are you ready to begin decoding these essential signals? Let us begin with the first signal, a phenomenon that has historically served as a potent harbinger of economic downturns: the inverted yield curve. Normally, when you lend money for a longer period, say to the government through a bond, you expect a higher return. This is because there's more risk and uncertainty over a longer horizon. This is the normal state of affairs, a steady upward slope on a graph. But what happens when this slope inverts? When short-term bonds, those you lend money for just a year or two, start offering a higher yield than long-term bonds, those you might hold for 10 years or more. This is an inverted yield curve, a significant deviation from the expected economic narrative. It's a signal that investors are becoming more cautious about the near future than the distant one. The why behind this inversion is rooted in collective investor sentiment and their expectations of what lies ahead. If investors anticipate an economic slowdown or even a recession, they expect central banks to cut interest rates in the future to stimulate growth. This expectation drives demand for long-term bonds, pushing their prices up and their yields down. Simultaneously, short-term bonds become less attractive due to the immediate uncertainty, leading to higher yields. It's a rational market response, not a mystical prediction. While it's crucial to understand that no single indicator is infallible, the historical correlation between an inverted yield curve and subsequent recessions is striking. It has preceded most major downturns in recent decades. Consider the spread between the 10-year and 2-year Treasury yields. When this spread consistently turns negative, remaining inverted for several weeks, it's a powerful red flag. It's not a call to panic, but a clear invitation to review your portfolio's risk exposure. Think of it as a doctor listening to your heartbeat. An irregular rhythm doesn't mean immediate collapse, but it profoundly signals an underlying condition that demands careful attention and a strategic adjustment. Our second signal, the Purchasing Managers Index, or PMI, offers a direct pulse on the health of our economy's engine rooms, the manufacturing and services sectors. Imagine a vast network of businesses, each appointing a purchasing manager. These managers are the first to feel the shifts in demand, the availability of raw materials, and the outlook for future production. They are surveyed, and their collective responses are compiled into this crucial index. The magic number here is 50. A PMI reading above 50 generally signifies expansion, a sign that businesses are growing, hiring, and producing more. Conversely, a reading below 50 indicates contraction, a slowdown in activity. What we watch for as a signal of potential downturns is not just a single reading below 50, but a sustained trend towards contraction. This suggests a broader, more persistent weakening in economic activity. Here lies a hidden truth. The PMI is a leading indicator. It tends to change direction before the overall economy does. It's not looking at what has already happened, but rather at the real-time sentiment and future upward expectations of businesses. A decline in the PMI, particularly in its sub-indices like new orders, foreshadows a future weakening in demand. This, in turn, can directly impact corporate earnings and, consequently, stock market performance. To apply this insight, monitor the headline PMI and its components. A consistent dip, especially in new orders, is a powerful signal that the demand pipeline is weakening. It's akin to the canary in the coal mine for the economy. When the canary shows distress, it's a clear warning that a problem may be brewing within the larger system, prompting us to reassess our exposure and strategy before the broader economic environment deteriorates. This is not about fear, but about informed awareness. Our third signal delves into the very engine of demand, consumer sentiment and confidence. It's a measure of how individuals feel about their personal financial prospects and the broader economic landscape. These are not abstract economic theories. These are the feelings of millions of people who decide whether whether to make that big purchase, book that vacation, or simply tighten their belts. The connection to spending is profound. When consumers feel optimistic, when they believe their jobs are secure and their finances are sound, they tend to spend more. This increased spending fuels economic growth, driving demand for goods and services. Conversely, a decline in consumer sentiment often acts as a precursor to a broader economic slowdown as people begin to pull back on their discretionary spending. It's tempting to look only at current spending patterns, but this can be a psychological trap. The true signal often lies in future intentions. A sharp and sustained drop in consumer sentiment, even if immediate spending hasn't yet collapsed, is a powerful indicator of potential future weakness. It reflects a growing unease that can translate into reduced economic activity down the line. Therefore, a strategic review of key consumer sentiment indices is essential. Look at surveys like those from the University of Michigan or the Conference Board. A significant and persistent decline, especially in their forward-looking expectations, serves as a critical warning. It suggests that sectors heavily reliant on consumer discretionary spending might face headwinds. Think of consumer confidence as the fuel gauge on your economic vehicle. When that gauge is dropping rapidly, it's an undeniable signal that you need to prepare for a potential slowdown, even if you still have some gas left in the tank. This awareness allows for proactive adjustments, not reactive panic. Our fourth signal addresses a force that can profoundly reshape economic landscapes: inflationary pressures, often met with the sharp tool of interest rate hikes. Inflation, the persistent rise in the general price level of goods and services, erodes the purchasing power of money. It can signal an economy that's perhaps growing too quickly, outstripping supply, or it can stem from significant supply-side shocks like disruptions in global trade or energy markets. When inflation takes hold, central banks typically respond by raising interest rates. This is their primary mechanism to cool down an overheating economy. However, this action is a double-edged sword. While it aims to curb rising prices, it also increases the cost of borrowing for businesses and consumers alike. This, in turn, can slow down investment, reduce consumer spending, and ultimately trigger an economic downturn. There's a hidden cost to this seemingly necessary intervention. Rapidly rising interest rates can expose vulnerabilities, particularly in companies that have taken on significant debt. It can strain financial markets, leading to corrections in asset prices as the cost of capital increases. What was once a manageable debt burden can become an insurmountable challenge when rates climb. To navigate this, we must be data-driven. Keep a close watch on sustained increases in core inflation metrics, those that exclude the often volatile prices of food and energy. Equally important is monitoring the pronouncements of central banks and the pace at which they are implementing rate hikes. A consistently hawkish stance, signaling a strong commitment to fighting inflation even at the risk of slower growth, is a clear indication of potential headwinds for assets that typically thrive in low-interest rate environments. Think of central banks battling inflation with rate hikes as surgeons performing a delicate operation. Their intent is to heal the economy, but the risk of unintended consequences or recession is always present if the procedure proves too aggressive. We arrive now at our fifth signal, a focus on the very bedrock of business health: corporate earnings and, crucially, their forward guidance. During earnings season, it's not enough to simply glance at the headline earnings per share. We must delve deeper, scrutinizing the quality of those earnings. Are they driven by sustainable revenue growth and healthy profit margins, or by one-off accounting maneuvers? However, in the intricate dance of financial markets, what a company says about its future prospects often carries more weight than what it has already achieved. This is the power of forward guidance. It's the management's outlook, their projection of what lies ahead, and it provides invaluable insight into their expectations for their own business and the broader economic environment. It's easy to get caught up in the game of beating the whisper number, that unofficial, slightly higher expectation that analysts might hold. But this can be a myth that distracts from the real trend. What truly matters is not whether a company slightly exceeds a whispered expectation, but the consistent trajectory of its guidance. Are they consistently raising their outlook, or are they repeatedly lowering it? The quality of their revenue sources also matters. Are they diversified and robust, or reliant on a single, potentially volatile stream? Our analytical approach, therefore, should focus on identifying companies that are consistently revising their forward guidance downwards. This is particularly critical for businesses operating in cyclical industries, those whose fortunes rise and fall with the economic tide. When a broad trend of downward revisions emerges across multiple sectors, it becomes a robust indicator of an impending economic slowdown. Benjamin Graham, the father of value investing, taught us that the stock market is a voting machine in the short run, but a weighing machine in the long run. Forward guidance is precisely this long-term weighing process, a consistent downward trend in what companies forecast for their future futures is a heavy sign indeed. We have journeyed through 7 critical economic signals, each a thread in the complex tapestry of market dynamics. From the inverted yield curve to corporate earnings, these indicators are not isolated pronouncements, but interconnected pieces of a larger economic puzzle. Understanding their interplay, how one signal can amplify or temper another, is where true insight begins. The ultimate aim here is not to achieve the impossible feat of perfect prediction. The future, by its very nature, remains veiled. Instead, these signals are tools for enhanced preparedness. They empower us to move beyond the realm of fear and uncertainty, equipping us with the knowledge to make more informed decisions about risk management and strategic portfolio allocation. As the venerable Warren Buffett wisely stated, Rule No. 1, never lose money. Rule No. 2, never forget Rule No. 1. This understanding is a crucial step in safeguarding your capital. The actionable takeaway from this exploration is to integrate these signals into your regular financial review. Don't wait for the storm to hit to assess your preparedness. Regularly monitor these indicators, observe their trends, and consider how they might inform your investment strategy. By proactively adjusting your approach, by building resilience into your financial framework, you can navigate potential market downturns not with apprehension, but with a quiet confidence born of knowledge and foresight. This is not about predicting the future, but about building the strength to weather whatever comes. The market will always present challenges, but with these signals as your guide, you can face them with greater clarity and conviction.